Hi, this is Jack Crooks from Money and Markets TV. Back in November, I laid out the case for a multi-year bull market in the US dollar. That prediction was based on my belief that interest rates will begin to move up in this country before they rise in Europe or Japan. US interest rates do seem to be heading higher, but interestingly, it's not the Federal Reserve that's driving the trend. I'll explain what is driving rates in just a moment. But first, let's take a look at the dollar's recent moves. It staged a sharp rally into January, then corrected back down. But now, the interest rate and macro background seems to be clicking into place for another leg up. Meanwhile, the yields on long-term U.S. Treasuries are rising, which could indicate the beginning of the end of the multi-year decline. That turnaround could coincide with a drop in the U.S. current account deficit as China shifts away from exporting its goods and towards developing its domestic consumption. If China continues this change in its growth model, it could pave the way for a major rebalancing of the global economy. That would have huge implications for the markets and for your investment strategy. For one, it would mean that U.S. long-term bond yields have likely bottomed. It would also mean that the next major growth phase for the global economy will be the rise of the Asian consumer. And it will mean that global capital and trade flow will now become a two-way street. China has kept its yuan currency artificially low for years to give the country's exporters an advantage in international markets. But with China's shift away from the export model, the yuan is likely to strengthen, increasing domestic consumer wealth and eliminating the need for China to buy U.S. Treasuries. Plus, since many other Asian countries take their policy cues from China, the entire region should see similar growth. Stronger Asian consumer demand and stronger Asian currencies mean Western consumer goods will flow more freely to the East, and the U.S. trade balance will improve dramatically. However, there are risks to this scenario. For one, the contagion from the European debt crisis could spread to emerging markets. We could also see a financial crisis in China if its debt grows to dangerous levels and the government meets unrest with violent crackdowns. And finally, the U.S. could trip itself up if our seemingly never-ending war policy continues and we're unable to reduce our fiscal deficits. But if we avoid those pitfalls, we may be able to escape the fiscal train wreck that we seem headed for. And if Chinese leaders trust their average citizen more, they will gain even more control over their own destiny. For the currency markets, all this translates into a positive outlook for the dollar relative to the euro and the Japanese yen as U.S. market interest rates rise. The greenback could also gain ground on commodity currencies such as the Australian, Canadian, and New Zealand dollars, which appear overvalued if China is slowing. I'm Jack Crooks from Money and Markets TV. Thanks for watching.